What is home equity? Home equity is the difference between your home's current market value and what you still owe on your mortgage. Formula: home equity equals sign, market value of home outstanding mortgage balance. For example, if your home is worth $450,000 and you owe $300,000 on your mortgage, you have $150,000 in equity. 2. How soon can you tap into home equity? General rule: most lenders require you to own the home for at least 6 to 12 months before applying for a home equity loan or line of credit. Minimum equity requirements: you typically need at least 15–20% equity in your home after accounting for the new loan. Some lenders offer delayed financing options, especially for investors, where you can access equity within 6 months of purchase, if you paid cash initially. 3. Types of home equity loans and lines: A, home equity loan HL, second mortgage, fixed lump sum, fixed interest rate, paid in monthly installments over a set term, typically 5–30 years. Pros: predictable fixed payments, good for one-time expenses, renovation, debt consolidation. May offer tax-deductible interest if used for home improvements. Cons: must repay the full amount whether or not you use all the funds, adds a second lien to your home, higher rates than first mortgage in most cases. B. Home equity line of credit, HELOC, revolving credit line, like a credit card but backed by your home. Variable interest rate, draw period, typically 5–10 years, followed by a repayment period. Pros: flexible borrowing and repayment, only pay interest on what you use, can reuse funds as you pay them back. Cons: variable rates can spike monthly payments. Risk of overspending, lenders can freeze or reduce your credit line during economic downturns. C. Cash out refinance replaces your existing mortgage with a larger one. You receive the difference in cash, usually comes with a lower interest rate than HL or HELOC pros, one mortgage payment. Lower rates than HELOC HEL. Longer terms, for example 30 years. Cons: resets your mortgage term, high closing costs, risk of refinancing into a higher rate if rates are up. 4. Tapping into equity during a real estate market correction. Pros: liquidity during uncertain times, allows access to cash for emergency funds, investments, or renovations. Opportunity to invest, market corrections can bring discounted properties. Tapping into your equity could help you buy low. Debt consolidation, use equity to pay off high interest debt when inflation and rates are high. Upgrade and add value, renovations funded by equity could increase your home's value, offsetting market dips. Cons: falling home values, equal sign, shrinking equity. In a correction, your home's value could drop below your loan balance, putting you underwater. Higher risk of foreclosure. If your income drops and you've added a second lien or refinanced into a bigger loan, missing payments risks your home. Reduced refinancing or selling power. Borrowing too much equity reduces your flexibility to sell or refinance later without bringing cash to close. Lender risk aversion. In a correction, lenders tighten requirements, freeze HELOCs, or reduce available credit lines, even mid-draw period. Strategic guidance for 2025 market conditions. Only tap equity if you have a clear plan. Use it to fund assets or improvements, not lifestyle inflation. Avoid over-leveraging. Keep at least 20–30% equity untouched to preserve flexibility. Prefer fixed-rate products if inflation or rate hikes are expected to continue. For investors, consider using equity to buy cash-flowing properties in undervalued markets, especially if you can use a DSCR loan or seller financing for leverage. If selling soon, avoid cash-out refis or second mortgages that reduce your net proceeds.